We'll get it going. All right. Good morning or good afternoon, I should say. So this is a little, as we used to call this, a mortgage potpourri, but we're going to touch on a little thing. Certainly, today's Fed day, so we'll touch on Fed meeting, which concludes here in just over an hour, or just about an hour, and then from there, Jerome Powell will have a press conference for probably an hour, 2 hours. Just a pretty much monotone delivery, but Wall Street will try to read between the lines of what they see going forward. So we'll come back to that. What I wanted to touch on here is kind of a cool, I don't say a cool report, an interesting report that came out. This is from one of our mortgage insurance companies, PMI companies, had done, some research and just to kind of scroll through a few pages on here that I thought were worth sharing. This is, so I got to move everyone's faces over just to get on the right page. So this is just a survey that went to 500 people in the 18 to 44 age group, just to kind of get a sample size of. This is basically a financial literacy quiz, is what they called it. So there were some interesting slides in here I thought that were worth sharing, and this is financial literacy. Gen Z, ages 18 to 24, just barely passed it at 67%. The younger millennials is their grouping here, 25 to 34, and the older millennials, 35 to 44. So basically, the best average is about a C grade. So just to kind of, and that's really no surprise, I suppose, on age, based on age, but still caught my eye a little bit. The big takeaways from this were um, look at this question. What is the minimum down payment typically required for a conventional loan? The answer is A, in case you're not already aware, but only 7.8% of those questioned got that answer right. 35%, so more than a third of this population, or I guess if you want to group B and D together, you're talking 78% of people thought you need between 10 to 20% down to buy a house. So just to be clear, for the record, conventional 5% is the traditional minimum, 3% if you're a first-time home buyer. But why I show this is just the fact that, we just probably take common knowledge for granted, or just assume everybody knows the requirements. And this stat, every couple of years, I see a report that shows this, and it still just blows my mind that, where that we as a community have to get the word out there that no, you don't need 20% down, and there are grants and everything else. The other bit in here, you see the takeaways here. Sorry, there's another one, but trust and generation. So this is Gen Z and millennials, trust in lenders. So between 30 and 50% have a trust in lenders. Maybe slightly less. Well, men versus women, I guess or excuse me, millennials versus Gen Z, there's a little bit of a variance there, but trust in tools. So Gen Z trusts AI and influencers more than lenders when they're getting their financial information. So that's more or less what the moral of this report was trying to kind of show. The big takeaways, again, less than 8% realize that you don't need more than 3% to buy a house. 60% said they would use AI tools to get home buyer information. 41% of Gen Z trust influencers like TikTok and everywhere else. Over half of 52% here feel overwhelmed by the financial information, and that often leads to a delay in home buying. So, anyway, I just wanted to pass that along. I know there is. I myself, I'm not social media guy, and Don and Chris probably to a more extent than I am, but we're definitely losing out on a segment of buyers probably because of that. I know I don't know if Chris Case is on here. She, in my mind, is the queen of social media. And Jeremy, I see your face. I know you're good with it too, but really is kind of it's becoming where first-time home buyers are going first to get information. So do what you can to stay in front of that. And again, if you're posting information on social media, obviously, if you're running out of content, just tap Chris, Don, myself on the shoulder. We're happy to give you a few bits of information. Maybe you're doing a weekly, tidbit on the finance world. We can certainly shower you with information. And check out our Sean Hadley CrossCountry Facebook page. There's data. Every day we post something on there that you can pull and share or copy and paste on your own. So for what that's worth.
Hey, Sean, I just want to reiterate, also state that be careful using AI when you're asking mortgage questions. It's great to ask AI about the whole home buying process and so on. But if you're asking for underwriting questions and guidelines, contact your loan officer, which is, one of three of us, because AI is not 100% accurate, in my opinion, or even close when it comes to underwriting guidelines.
100% correct, because that's aggregating from so many different sources. As we often joke, what we see on the internet isn't always true, and that's a good point, DJ. All right, this is a can't miss. I'm gonna spend a minute on this, but Chris or Don, if you have the link, or I could pop it in here before we're done.
You can get
Tom
it.
Ferry, who I think is that's a buzzword in the real estate world. We are bringing him in to Cleveland for a full day seminar on listing edge. So I hear nothing but great reviews. They had a representative from Tom Ferry in at a corporate office, and it sold out in, I don't know, sold out, but it was booked in literally hours. So they're bringing him back, bigger venue, the Hilton Cleveland downtown, 8 a.m. to 5 p.m. You guys know how CrossCountry does things. It's going to be great. It's going to be fantastic. So it's October 15th. So I would absolutely encourage you guys to sign up. When they made the announcement to us on there, there's a live page. There were 113 people signed up for it, not working for CrossCountry before the 30-minute presentation was even over. So people are getting the word out that quick. So we have a big venue and plenty of room, but I do expect it to fill up and sell out prior to. But again, no cost to you, and I would encourage everybody to sign up. Chris or DJ, anything you guys want to add on that?
No, I was just gonna say the best part of this is no cost to you. And like you said, it's a great venue.
Mhm.
Tom Ferry, great speaker. I think you'll walk away with a lot of information.
Cool. All right,
It-
let's jump into interest rates and Fed Day and all of that. So here is a chart. You guys see me pull this up pretty much before any presentation I'm giving, either live or in Zoom related to classes. But this is just kind of Mortgage News Daily is what I would say if you go to bankrate.com or whomever, these sites are just loaded with ads, and you can never tell what's an ad and what's true data. Um, this site I say is more for mortgage nerds. It's where Chris and I go, just kind of pull some quick details or headlines specific towards the mortgages. And so this is kind of just shows you, I pulled this up from approximately the first of the year. So the 30-year fixed average here was just over 7% at the start of the year. I don't think anybody's probably surprised by that. Wasn't that long ago, and it wasn't that long ago that rates were over 7%. So kind of just hedging along here. We got a nice little dip in April, but you can see that was short-lived from April 4th to April 14th. And rates dropped about a 0.5%, or excuse me, jumped up about a 0.5% in a 10-day period. Pretty, pretty, pretty crazy spikes, dips in along the way. But here we are. Let's just go back and look. So the Fed meeting is today. The Fed is going to drop the federal funds rate. It's a 96% chance they're going to drop it a quarter of a point. This is not news. That action by itself isn't going to move interest rates. What happens after might, but this was basically a foregone conclusion as we got along here. Do you see where rates were kind of 30-year averages were on 6.75 on July 31st? And on Friday, 2 days later, all of a sudden we're at 6.58 and the trend has continued. What came out the first Friday of the month, what comes out the first Friday of every month are job numbers. The job numbers came back bad. Bad job numbers is bad for the economy, but that's good for interest rates. So as soon as this happened, it was like, oh, you know what? This is going to force the Fed's hand. Even if they don't want to, they're pretty much going to have to drop the federal funds rate in the September meeting. And then here we go, kind of blump, so bouncing along here through August. What do we have here? First Friday of September, Friday, September 5th, and look at another drop from over 6.5 to under 6.5. Again, this is kind of the national average 30-year fix, with or without paying small amount of points. It's a survey, but you see that saying, oh, you know what? That just confirms what we already know. Fed is going to have to drop the federal funds rate a quarter of a percent, and here we are today. So the generally speaking, if and when the Fed drops this a quarter of a percent, that action isn't going to move interest rates because everybody's known for about 6 or 8 weeks that this is likely to happen. But after that meeting, there's going to be a 2 hour press conference, as I mentioned, that's going to roll on with Q&A, and uh, Wall Street's going to try and read between the lines and say, okay, is there going to be another drop before the end of the year? And I would say I could pull up the fund futures, but their expectation, Chris or DJ, correct me if I'm wrong, I think the market's already priced in probably another quarter drop. Would you agree?
Yeah, I would think so.
Yep. Okay. So that's just to give you an idea of where we're at. Now, just to take this snapshot out, does anybody want to take a stab at where rates were a year ago today? Anybody? No? You might be surprised. Look where we
Seven
were
and
a
a
year
half.
ago today, roughly
No.
6.11%. Rates are pretty much about where they were a year ago, but you may or may not remember, you may have forgotten because it was such short-lived, where rates went from like the mid sixes down to the low sixes and right back up in a few weeks' time. It was such a narrow point, and we see these dips and valleys along the way. And just for fun, well, let's get that out of
If
there.
I'm not mistaken, Sean, what kicked that up real quick was a positive jobs report.
You're right.
Jobs will control interest rates more than anything right now.
Yeah, let me go back to that. Hold on one second here. There we go. First Friday of the month, October. You're exactly right. They went up about 1/4% because of a jobs report. So jobs, inflation, Fed meetings. Right now, those are the three big things. If any of those, well, inflation and job reports are every month. Fed is not quite every month, but those are the three biggest movers as far as the rate. So, Chris and DJ, anything you want to add on that part, or any? Do you want me to scale out this graph at all for any reason? Let me know. Um, Let's jump over to, oh, of course, just give me a dead number here. The 10-year. So hopefully everybody was on the Tuesday call with the
He had
short-haired
to cut his
version,
hair.
Mike Rapaski. Yeah, that was fantastic. As I mentioned to him, he's a lot more trustworthy with that short hair. Anything he's talking about the market, I'm definitely into. Geez, I'm not sure why this isn't showing, but what I was going to show is the 10-year. So Chris, or excuse me, Mike had mentioned, pulled up a few slides just showing the 10-year and the 30-year. About they don't quite mimic each other, but they certainly trend in the same direction. And that is when the 10-year improves, usually the 30-year mortgage follows suit. So they are, unrelated, but
It's up there on the right. It's 4.05 right now.
there it is. All right, let me see if I can click on there. Not sure why it is. Usually it gives us a live graph here. But the margin between the 30-year and the 10-year is narrowing a bit. That's part of the reason you're seeing rates improve, along with the 10-year and treasuries improving overall. So I was going to try and pull this up, but we may just skip that part. But Chris or Don, do you guys want to chime in on the 10-year? Not sure what I'm going on
Well,
here.
as I was talking with you earlier today, it's odd, and the 10 years a barometer. It's not exact science. And the funny thing is, the last 24 to 48 hours, you had a lot of experts in this field on social media talking about the correlation from where we started 2 weeks ago at 4.3 in a 10-year to today being 4 point, well, was it 4.05 or something like that? There's almost exactly a 25-point basis drop, which is what the Fed's going to drop. That's unusual that that kind of a drop correlates exactly with what the Fed's going to do. Because again, the 10 years a barometer. It's not exact science, but it is what the mortgage industry kind of follows on a day-to-day basis to see where the rates are going to be going. As you can see by that mess right there, that's what we have to base our rates on. Up, down, sideways. It's crazy. And that's throughout the whole day. That's not over the course of time of days, weeks, or anything like that. These are charts running during the day. Rates can move multiple times during the day, up or down. That's why when we run pre-approvals and we quote somebody an interest rate, it's just in a pre-approval rate. It's just something we're basing everything on at this point in time. Actual rates for your loan are determined once you have a purchase agreement and are locked in. So that rate could change up or down or stay the same by the time those folks buy a house. And I always usually bake in about 1/4% higher for qualification purposes to account for higher taxes or higher insurances and market movement when I do pre-approvals, just to give the borrower some wiggle room.
That spread is interesting too. If you look, you had the longer chart there, all the way back to September of last year. We were at similar mortgage rates, but the 10-year was way lower.
Yeah, that's a good point. So yeah, you're saying a year ago, 30-year was in the low sixes, and you would think then that if today's 10 year is at 4, you would think the 10-year was about 4 back then. It was all the way down to 3.6. So I would say that's an anomaly on one end or the other or both. So yeah, that is a good point.
Yeah,
Because I think right now we're following jobs more so than anything than the economy. I mean,
yeah.
the jobs are the economy, but I think our rate drop, or believe our rate drop, is truly tied to the terrible job reports, the last two or three reports.
Mhm. Yeah, yeah, you remember I showed you the year to date, how we were hanging around 7% on the 30-year fixed. And if we match these up, they're very, very similar when you put them side by side. So now, Chris or DJ, feel free to chime in, but let's say I'm going to be exaggerating in what's the verbiage would be, but if Jerome Powell kind of let on like, oh geez, we're dropped at 0.25%, we almost did a half. We're really worried about these employees. We think we got inflation under control. We've got that in the bag, and now we're just panicked about job numbers. What would they do next? What would we expect to happen with interest rates then?
Well, you guys see where the dot plot goes too.
Oh yeah, that's right. It's
Yeah.
dot
Because
plot.
the dot plot, it's
Yeah,
the dot plot seems to throw more weight into anything. And dot plot is future guesstimation of rate cuts.
this is fun.
I
Mr.
know we're
Wright,
getting
you
really
love this
technical here,
one.
guys, but this is what's the stuff we're talking about in the next 2 hours is what's going to sway interest rates in the coming days and today.
Let's see where the dot
We
plot.
could play dot plot bingo. That'd be fun on our next call.
Oh yeah.
That would be. So what the dot plot is, it gives a survey here. Let me see if I can pull up I think this is from June. So this one, I think it's quarterly that they do it. I mean, I joke that they just they don't really scientifically do this. They just want to come up with a cool design. This looks like a girl in a dress to me. But so what they do is the all of the reserve board members kind of do their predictions of where they see interest rates at the end of 2025, in 2026, 2027, and then the longer run. So you kind of get the trend of if everybody's kind of grouped together, that kind of means okay, they're probably all on the same path. And not to say the predictions will be more or less reliable, but you look at this one saying, okay, well, you've got two board members thinking the federal funds rate will be up around 4%, and two that think is around 2.5%. That is a wide range in the big picture, and it's not one-off anomaly like maybe these two down here. And DJ, how would you define what is the federal funds rate? Because the rate that they're changing today is not the 30-year fix. It's not technically prime rate. What is that? How would you explain that?
No, the federal funds rate is simply the overnight pricing that banks borrow money on. So when the Fed cuts rates and those federal fund rates drop, that makes money a lot more attractive to corporations, which means they're going to spend more money, which could mean possible job hirings and expansion of their companies. So the lower we get that federal funds rate is, the better it is for, I know people get pissed about the corporate world making money, but the better it is for the corporate world because it's their overnight, it's the money you borrow, the cost of borrowing money overnight for banks and institutions and corporations.
Mhm. And we'll post something maybe on the Facebook KW Agents page just to give a little blurb about what before the end of the week. We'll probably let the dust settle today and then put something on there just to have you something if you wanted to just take some notes. Or I know some of you on here might reach out to us and just say, hey, I'm going to sit down with a customer about a new listing or a new buyer. Just give me a quick 30-second rundown because they're going to ask about interest rates or want to know what's going on with the market. So just feel free to call, email, text any of us, and we'll give you a kind of a whether you want 2 or 3 sentences to post somewhere or just a few bullet points to put into a listing or buyer's presentation. Just more than happy to do that. So for what that's worth.
There's conversations I had yesterday that there are some people locally that were actually stating rates are going to go into the threes. Guys, the only ways we're going into threes if we go to war, and I don't even want to talk like that, but you saw what it took to get rates into twos and threes was a worldwide pandemic. Your next thing to get rates into threes is going to be some sort of all-out war. Nobody wants that.
Mhm. We
You could have all the rate cuts in the world. It's not going to take rates into the threes.
And you won't be surprised that we're getting phone calls the past
Hmm.
6 weeks about refinances. We're staying in front of our old customers, of course, first and foremost. If there's opportunity to refinance, you may remember the buy now, refinance later. We still have that extended, by the way. So if somebody closes on a house with us, we close in September. And they end up coming back and refinancing in the next like 10 or 12 months. We will waive our lender fee. So it's something we've been cashing in those coupons to people refinancing for quite some time now. So we still have that going for new customers, but all the old customers who qualified for that with their purchase to carry over, we're talking to them now. So it's been, 2 years ago, October of 2023, interest rates. You don't believe me? Let me just pull my little chart open here.
And Sean, the other thing is too, the good thing with interest rate cuts, there is an immediate impact on two things. Home equity line of credit. So everybody has a HELOC out there, your rate will drop accordingly, either a quarter or half, depending what the Fed does. And if you're searching for new car loans, you will see your car loan interest rates come down by a quarter or more. I'm starting to see cars being offered again 0% for 16, 72 months. So, that just tells you the economy sucks when you start seeing 0% interest rates for vehicles. That's IMO, my opinion only.
Yeah. You heard it here first. The economy sucks by Don Drake. So here's where we were 23 months ago, October 2023. You see that surveyed rate at 8.03. And by the way, that was probably paying a half a point or a point at its highest. So think of who bought then, has the opportunity to refinance now. I mean, so I know everybody, we've got this sort of stuck in our brain that, oh, interest rates used to be 2 and 3 and 3.5%. Those days are gone. They're not coming back, but there's an opportunity for anybody who bought here after May of 2023, here we go, 2022. There are people selling homes already that bought then. So they aren't in that, hey, I don't want to leave my 3% interest rate. And Chris, Don, myself, we stare at interest rates all day long, like they are the most important thing. And we know any buyer who's buying, if they're putting their list of top three reasons why they're selling, moving on to the next house, interest rate's not going to be in there. Even if it was a 3% interest rate. They're moving for 1,000 other reasons. At least that's typically what we would expect. So cool. So I'm gonna jump into the next topic here, unless anybody want to stay on rates or the Fed or any questions on that? No, Chris or DJ, anything you guys want to add?
No, you move.
Okay. All right. So what I wanted to talk about, a few other things that we put on our to discuss sheet was just different loan terms. So if you guys have been on the Tuesday call, Zoom, or in the Tuesday meetings, you've heard us, I mean, over the years, but again, recently kind of mentioning, hey, for a while there, the 30-year fix is kind of hanging up around 6.6. And we were saying, you know what, if you want to do a 20-year or a 15-year, you can always get a lower interest rate, but especially now it's priced out pretty aggressive. So what I wanted to show you here, and this is on our webpage, you can easily just plug into resources, calculators, and plug this in, is I took just a generic scenario here. I said, okay, let's say you got a 250 loan amount on a 30-year fix, and I'm using a 6.3% interest rate. This is going to show you in the left column here, obviously your principal that you're repaying in that over that 30-year period is 250,000. How much is the interest? Even though we see these numbers every day, that Don, Chris, and myself, but all of you obviously either see these firsthand or secondhand, the interest. So this $250,000 loan, if they were living there for 30 years, if they were making the minimum payment, is $307,000 in interest. They're paying well over what they're borrowing in interest alone. So I put next to it a 20-year, which you get a nice little rebate. I mean, you can get in at under 6% pretty comfortably, 5.99, 5.875, and we'll see what happens here in the next couple of days, but maybe even a bit better. Look at the difference. Obviously, you're paying back the same principal, $180,000 in interest. That is a huge, huge savings. And the difference in payment, I skipped over that here. I apologize. You're paying about what is that? About $240 more per month to save this much interest over the life of the loan. Now, I bring this up as I'm talking to customers, just say, hey, 30 years is the norm. It's a vanilla flavor. If you want to look towards a shorter term, more than happy to do that. The payment's going to be higher, and we have that conversation. And if I'm talking with a first-time home buyer, who's kind of squeaking into this property, maybe barely qualifying, and they're talking themselves into this higher payment, I will be the first to tell them, hey, you know, if you're not comfortable with taking on that shorter term loan with the higher payment, don't do it. Go with the 30-year fix. That's a good, safe one. Any loan that we have has no prepayment penalty. And I will show a buyer this chart and say, hey, if you do this loan, number one, and make this payment, you're still going to pay it off early. Not quite 20 years, probably 21 years, but don't overcommit. Don't commit to something, that you might, regret later on. Of course, taxes can go up, insurance can go up. People, can lose their jobs or have other financial stresses. So I'm not telling people to go all in with a shorter term, but it is a great opportunity in some cases. And you know where we're having a lot of these conversations? Someone who had a 7.5% interest rate a year ago who's calling to refinance today, they might be all over a 30-year and saving $300 a month. I might say, hey, you know what? You want to see what a 20-year looks like? Your payment may actually stay the same. And instead of you paying your mortgage off in 29 years, you're going to pay it off in 20. That sounds interesting. Thanks for pointing that out, Sean. And hey, no thanks. I'll go with the 30-year fix. But we want to just let a buyer know they always have options. A 30-year fix with or without points isn't always the only option out there. And then just to show you, you can get a 15-year loan down in the mid fives right now. Look at that. Let's see, calculate $117,000 in interest. So just the power of, the amortization schedule and, there's tools like this all over the web page, all over the internet. Our web page has got some nice ones. What I also did put in there was the biweekly payment. So this is taking that same $250,000 loan over 30 years, and CrossCountry and pretty much every lender allows a buyer to sign up for biweekly if they want. So I know this is probably basic knowledge for you, but the whole benefit or the whole where the math works biweekly is you're paying 26 half payments. So if you do the math, when you're paying 26 half payments, you're making one extra payment a year, and that extra money is going towards principal. So this just shows you a breakdown of well, this one does the math for you. You save $71,000 in interest over the life of the loan, and you're paying that loan off almost 6 years early. Now, again, most of the buyers we're talking to, they're not going to be in that mortgage necessarily for 30 years. They might refinance, they might move, but again, this still is impactful when you're looking at that. And you can run these scenarios. We've got other spreadsheets where you could say, okay, but do this after 5 years. I'm not going to be there for 30 years or 20 years. Tell me what the savings would be after 5 years. Chris, Don, and myself, we've got some prepayment calculators, and they're on here too. So just be aware that these are, you yourself might not think a biweekly loan is a great idea or a great advantage, but your buyers might, or your buyers might ask about it. Or like we started this off, they may see one of those, your lender's cheating you, TikToks. You've got to go to biweekly payments. And this TikTok is announcing it like they just thought of this and invented this idea when every lender has it as an option. Or I mean, not every lender, but most lenders have that. So we're happy to, consult a buyer about the pros and cons. And oh, by the way, I think when biweekly first came out, it's back when people all got paid biweekly. So it's sort of like, okay, cool. My paycheck goes in, my mortgage comes out. So it sort of syncs up. Nowadays, you have a lot of people who are paid on the 1st and the 15th, or who are commission based and paid when a house closes. So maybe they don't want to sign up for that biweekly just because the ebb and flow of their income, there might be some bad months. So just do the math. If in this case, if someone's payment is $1,500, hey, instead of paying twice a month, why don't you just make one extra payment a year, or in this case, an extra $125 a month extra is the same as paying biweekly. It's the same as paying one extra time per year. So these are just sort of, again, sometimes we just assume, hey, this is simple math. You can figure this out. We shouldn't have to tell you. It's our job as loan officers to educate the buyer on what options are out there, and what let them make the choice for what may be best for them. So anyway,
Sean, what this says more than anything is that the three of us are not rate quoters. We're going to give your clients options and help them make the right choice. So we're not rate quoters. I mean, you can call any bank right now and just ask what the rate is. They'll tell you, and they'll get off the phone. We're going to talk through the situation, find out what's going to work out best for you, and give you a few different options and help you make a decision from there.
As we like to think of ourselves as consultants, because I was gonna let's tell you a story from back in the day when I first started, but we're gonna skip that. The dinosaurs were still walking around and everything, but yeah, we like to set ourselves apart. I mean, when we talk to a customer, we're not reading a script. That's just to get them to the next stage of sign here, sign here, sign here. We really want to sort of educate the buyer on their options and look at it both ways. So I'm working on someone who's doing a refinance. They said they want to refinance and pull a little cash out for some modest home improvements. Sounds like a great idea. The guy bought in 2021, has a ton of equity. He's going to lose out on the interest rate he has, but he doesn't have many other choices. He can't get a home equity line of credit for a couple of reasons, but we're going that route. And then when I pulled this credit report, I said, okay, well, your score is lower, which is preventing you from doing what you originally wanted to do. Do you know why it's lower? And yeah, because I have all this credit card debt. It's like, hey, pull out an extra $25,000 is an option. An extra $25,000 to your mortgage is about $350, $225 to his mortgage payment. And do you know how much he was by paying off these other credit cards that were probably never going to be paid off? He was getting rid of about eight or $900 in other debt. So yeah, he's paying 325 more a month on the mortgage, but he's wiping the slate clean ultimately. So again, he didn't have to do that. I'm obviously just want to give him choices, but not everybody looks at it that way. Some people chase that credit card debt like, they're chasing their losses at a blackjack table. Been there. So you want to kind of help them get to where they want to be and just sort of show them all the roads to get there, I guess. Um, Perfect. What I'm going to jump into now, buy down. So with buy downs, you've got temporary buy downs and permanent buy downs. So just to talk about the difference, a permanent buy down is when we say, okay, just use round numbers. Let's say today's interest rate is 6.25%. And we say, if you want to pay a point, we'll lower that rate to 5.99. So 1 point is 1% of the loan. So if you've got a $200,000 loan, that buyer's paying $2,000 to get that lower interest rate, and they're going to save about $32 a month, give or take. So that's what a permanent buy down is. That rate is lower for the life of the loan. Right now, with rates dipping, and could they improve? Yeah, but I don't know that we're all that optimistic that they're going down to 5.5 or 5.25 real soon. So paying points to get a lower interest rate isn't necessarily a bad idea. There's a very good possibility you may have this mortgage for more than 18 months. Very likely 4 or 5 years is reasonable to think. A temporary buy down is where you say, okay, we're going to take this money and instead of buying it down for the life of the loan, we're going to buy it down for a shorter period. So where we usually hear this is when rates are high or when sellers are trying to, kind of throw the buyer a bone to try and, entice an offer or a deal to be made. So just talking this down, what I have here is the extreme, a 2-1 buy down. So you've seen this flyer before, but this kind of just to walk through what this is. This is it as though somebody had a $250,000 house with 20% down, they're getting a $200,000 loan. And just to keep it simple here, let's say you've got a 7% interest rate. That means their principal and interest is going to be $1,330. What a 2-1 buy down is getting funds from the seller or the lender or the realtor or some other resource to buy the loan down. And this one, the way it's broken down is, hey, we're going to lower your interest rate 2% for the first year, 1% for the second year, and then you're back to your 7% interest rate after that. So you could see it's pretty significant savings, but it's being funded separately by way of this buy down. So again, seller, lender, agent are kicking in funds for this to cover this. So where we saw this was, remember back in 22, 23, rates went from 3 to 4, 4 to 5, 5 to 6, 6 to 7, and kept on going up. You had buyers going, "Wait, I can't keep up with this. You know what? I can grow into that payment. I can eventually afford this 1330, but I can't do it right now." So they're coming up, these programs were back in place. And also you had sellers kind of throwing money to the buyer. So that's kind of a perfect storm. I don't know if perfect storm is a word, but the stars were aligned to where this was financially impactful and a benefit. Again, you still make the argument this is coming in handy now. I mean, right now, I don't think buyers are dying now that rates have come down. They're not all hot on, lower rate, lower rate, lower rate, buy down, buy down, buy down. But listing on the selling side, sellers might say, hey, you know what? Rather than doing a 3% price reduction, let me throw money at this buy down to entice a buyer to come in. Because you could put that in your MLS, seller offering 1 year buy down or 2 year buy down. And you can talk to us about that, whether it's, putting together a customized sheet like this, or just explain to a listing agent what it is, or of course the benefits to a buyer. But this has been a hot topic on again, off again for the last couple of years. So I just wanted to address that as well. And again, tell you the difference between a permanent buy down and a temporary buy down. Chris or DJ, what can you add to that?
Well, to me, this is something that's used in a higher interest rate environment. Can you use it in a lower rate environment? Sure. I mean, if you're at rate 6, you can go 4, 5, 6. But again, this is something that's used in a higher rate environment. This is something that builders use a lot to move their inventory that's just sitting. Or if you have a house that you're looking to do a price reduction on, maybe you offer some seller incentive to pay the cost of a buy down versus versus dropping the sale price. Buyer gets a much, much bigger bang for their buck using that than getting a price drop. If there's any way for you guys to get that in MLS, I don't know, but that's another way to use this. And then don't forget the permanent buy down.
Perfect. I just opened the chat and I saw Allison comment, this is the most fun I had in years. I can't tell if that's serious or not, but I love it either way.
It's
So
kind of
thank you,
along with the
Allison.
PMI class we offer,
Oh
right?
yeah, yeah, yeah. I've been teasing that PMI class and I may really bring it back here soon, but yep.
Hey, Sean, bring up the fact of what happens if we're in year 2 and they decide to refinance. What
Good point.
happens with that? What happens to that money in that escrow account?
So here we've got the seller or somebody giving the buyer, hey, here's $4,600 to lighten the load for you for the next 2 years. And let's say rates go down after a year. Buyer might think, oh, geez, I got all that money invested. I don't want to lose that. I'm going to ride this out for 2 years. Don't need to wait. Let's say a year into this, there's $3,000 of this is still left over. That money is theirs. That's their money in an escrow account. So it can go towards closing costs or buying points or, even towards another buy down on the next go around. So good point, DJ. That money is not lost. So in a downward, even though rates are going down and a buyer has this opportunity, it still is an opportunity and they're not going to lose money along the way by investing in that, if that makes sense. Cool. All right, let's get back to some nerding out. So this is the Fed futures. So this is, based on today's meeting, they're pricing in for the Fed to drop the federal funds rate to 4. They don't give it's not an exact figure, but it's 4 to 4.25. So 96% chance, essentially, a tiny little chance, whatever you would call that, a 1 in 20 chance that it's going to get a 0.5%. So unlikely. But let's scale this out and say, okay, well, there's another one right before Halloween. All right, there's a 73% chance of another drop. This is what the markets are pricing in. Quarter today, another quarter in October, and then let's see what December. Yet another quarter, about a 66% chance of, being another quarter better. So just so you see what's being mapped out, this is I don't know if it's a fun watch, but playing around with this chart is crazy. So if you guys wanted to, log this in and say, okay, well, right now, as of right now, 20 minutes before the Fed meeting concludes, there's a 70% chance that there's going to be a quarter today and a quarter next month. Wait till like an inflation report comes out or an unemployment number comes out. You'll see this jump up to 80% or drop down to 32%. And it's crazy. I mean, it just goes to show how crazy the markets are because everyone's, trying to predict the future off of something that might or might not happen. It's pretty wild. So, Chris or DJ, anything you guys want to add on?
No, that's
What,
pretty to the point there.
how much of the December cut do you think is priced in? Because I think they probably are pricing in today and October. I don't know about December yet.
Yeah, I feel like they're probably 60 days out. I would agree on that. Yeah. So
Yeah.
they're probably factoring in that October, or I would say if you were to ask, someone, if whoever puts these analytics together, I'd say they're probably factoring in at least one more drop before the end of the year, meaning October or December. And if we
Hmm.
get both, it's a gift. I think that's kind of the way the market is priced right now.
Yeah, because another cut in December, let's say we get all three,
Mhm.
going into the spring market, I mean, you're looking at some pretty aggressive rates.
Yeah.
I'm knocking on every piece of wood I got in my office right now.
I'm a firm, like I said, I've been saying for a while, I think spring of next year will be some sweet spots.
Yeah.
Yeah.
Boy, like from Chris's mustache covered lips to God's ears.
You could put that on a t-shirt, I think.
Cool. Well, I'll give everyone if anybody wants to chime in, please too. But I'm going to pop this one up again because this Tom Ferry event, I think it's a can't miss. If you can, slot aside some time during the day, even if you can't make it for the entire day, I think it's well worth it.
Yeah.
Tom Ferry again has a really I know a few other realtors had mentioned the first event that Tom Ferry's company was involved in here in town, and were bummed that we couldn't get in for it. So this is anyway, should be in high demand. I hope to see a lot of you there. But any questions, any comments, anything that anybody wants me to any different screens you want me to pop on, or payment scenarios to play around with?
No, when you sign up for this Tom Ferry thing, there is an hour and a half lunch that we're providing lunch.
Do you know how many slots there are for this event too, Sean?
They didn't give me a number. I know it's several hundred. Uh, I know the one hall at Hilton. We had an event there years ago. I mean, if I had to guess, I mean I'm guessing 400, 500, but I can't say for sure. So the reason we're doing it at the Hilton is just that it's outgrown the space for our office, and for most of you seen our corporate office, we could pack it pretty tight in the atrium there. So yeah, this is gonna be good.
Yeah, so the reason I bring that up, it's less than 48 hours since this announced, and the current number is over 260 right
Yeah.
now are signed up. So
Yeah, I mean, I think everybody who's listening to this already has it, but if this happens to be a recording, this is going to be in the Facebook page as well. So we'll keep it reissued in there. So, all right, cool. If nobody has any questions, I guess we'll close it out right at the roughly 45-minute mark. I got CNBC in the office. If anybody's in the building here in Pepper Pike, swing on over and we'll have a little Fed Watch party. I mean, I don't know how much of a party it'll be, but we got some seltzer water and some chips and popcorn. So swing on by. And Chris DJ, thanks for joining us always. And we'll be around if you need us.
Good day, guys.
Thanks.
great. See ya.